Welcome to the Circle Investor Podcast. If this is your first time listening to the show, we talk about all things Central Indiana real estate, business, and beyond. If it's not your first time listening to the show, then welcome back. On today's episode, we talk about... We should clip this and post it and get people to argue about it.
You want to buy a house? Okay, can you breathe on this mirror, right? Will your breath show up? Okay, you're good to go.
Thank you for coming on the podcast. We're here, Circle Investor Podcast. We have David Powell with us. David is the president and senior mortgage officer for Powell Home Mortgage. And we were just talking about you are a boating and lake enthusiast.
Oh, yeah.
Down at Sweetwater Lake.
That's right.
And that's you've been working in the mortgage industry for 20 years now.
20 years right out of school. Yep.
Wealth of experience there. So yeah, thank you for coming on the show and hanging out with us.
Yeah, appreciate you guys having me.
You're an IU guy, right?
I am an IU guy. Yeah, I actually, my degree is in journalism, believe it or not. Went there for advertising.
Yeah.
Came out, graduated 2005. Realized pretty quickly that if you weren't moving to LA, Chicago, New York, that to be writing ads probably wasn't going to be realistic. I mean, you could get, there's smaller ad agencies in the Midwest, and there's some good ones here, but starting pay and copywriting for ads just wasn't too appealing once I got out. So,
yeah,
it's understandable. Yeah, I went Kelly graduate as well.
Sweet.
Marketing, but yeah, work in property management now. So that's how it goes.
It's funny how it works.
I actually tried to push into the PR and advertising agency. It was for me, it was kind of a weird experience gap, which I understood, but it almost felt like an industry that I wanted to get into, but it didn't want me in it.
I get that. Yeah.
It felt very cliquey. So nothing against the industry in general, but yeah, it's tough. And like you said, starting pay was questionable.
Dismal.
Yeah.
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 Yeah, and the ad agencies around here, again, they're great. But what I found is the job openings only come around when someone retires or dies.
Yeah.
And then you come in and you're 20 years younger than everybody and low man on the totem pole and pay isn't great. And so I had a friend that had an older brother that had a mortgage company and talked to him a few times and eventually just started there. And I don't know, I've been stuck in it for 20 years now, right?
Must be something good about the industry, right?
Yeah. I mean, it is good. It's flexible. As far as schedules go, you kind of do your own thing, not micromanaged or anything. You got goals to hit and you hit them. You got to put people in their homes and they're thankful. And it's rewarding.
Yeah. And so I'm doing the math. So you got into it 20 years. That puts you in 2005.
I've seen some things.
You've seen some things. Yeah.
It was completely different 20 years ago. Oh,
so
yeah.
It was 2005 seller's market, 2006 seller's market, then 2007. That had to be such a wild transition.
Yeah, I mean, it's not so much the seller to buyer market that was the biggest shock. The biggest shock is kind of what we used to be able to do versus what we can do post 2008, 2009.
Yeah.
I mean, 2005, I hate to say it. I mean, we had jokes that, hey, you want to buy a house? Okay. Let's see if you're alive. Can you breathe on this mirror, right? Will your breath show up? Okay, you're good to go.
You can have a house.
100% financing.
The 100% financing is always what gets me. Yeah.
We could do 100% financing for investors.
Wow.
We could do 115% for owner occupied for some people. So you would get not only the full price, you get your closing costs and then a little bit of spending money for rehab work or
because
whatever.
Why not? Yeah.
Yeah, and I think the reason behind that was that
it's an appreciating
everybody
asset.
Expected home values to appreciate, right?
Yeah.
So as long as you don't need to sell in the first couple of years, you're going to be just fine.
Yeah.
But learned out kind of the hard way. That's not really how it works. Also, loan programs out there. There were stated income, stated asset. I don't know if you've ever heard of those. Basically, you hand your client the application to fill out, and they put on the application what their income is, put what they have in the bank, and you roll with it. There's no collecting pay stubs, no collecting W-2s. I think if I recall correctly, we did have to call and actually verify they were employed. But beside from that, there was none of this
income verification.
Exactly.
Yeah.
None of the due diligence.
It's amazing. It almost just feels like how, in the 1950s your doctor smoked. It's just like looking back on it in retrospect, it feels so just foreign to be like that, that the rules were that loose. But I feel like I always get this wrong, but wasn't like sort of the home mortgage as a financial instrument, wasn't it created in like the 1970s?
60s or 70s, yeah. Okay. Yeah.
Because it's almost like we had to learn that lesson the hard way.
It took a long time.
Yeah.
But here we are. And you know how hard it is to get some people qualified who, even some people that should get qualified, common sense has gone out the window in lending.
So do you feel like it's swung almost like too much the other way? Or
I'm not going to say it's swung too much the other way. I think it has tightened up to a point where it had to tighten up, right? But there's no common sense. Everything has to sit in a box. It has to be able to be sellable on the secondary market through these Fannie Mae, Freddie Mac guidelines, right? So, just a simple example, if you take debt to income ratio, Fannie Mae, Freddie Mac have a hard line at 49.99% on a debt to income ratio. That means if you are 50% or 50.1%, you can't get approved. And this could be someone who makes, let's say you make $1 million, right? So your income level is fine.
Yeah.
Right? Even if you're spending half of your income, $500,000, your debt to income ratio is at 50%. Even if you still have another $500,000 to spend,
you can't go get a loan for $200K because even though you have $500,000 in income to service that loan, you're not allowed to use that because of that
there's a hard line.
That hard line.
And it's not the millionaires that are being hurt. That's just an example I throw out there. It happens more often. We see first-time home buyers who more or less, and the market now, it's hard to find a livable house for under $200,000.
Yeah.
Right? But these people are paying $1,800, $1,900 a month in rent, doing just fine. Their credit scores are fine. They go to buy a house that's maybe $1,600, $1,700 on payment, and we can't get them approved because the debt to income ratio is too high.
Yeah, we're saying that, okay, you make $3,000 a month, but we can see in the debt that you have that $1,500 is gone, or a little more than 50. So you're over that 49%. But so instead of getting this mortgage for $1,300 a month, we think that you should just keep paying rent for $1,400 or $1,500 a month.
Exactly right, and that's where common sense kind of goes out the window.
Yeah,
and there's ways to check that. You can go back and pull people's bank statements and say, oh, sure enough, every first of the month, this guy's paying $1,700 a month, right? You can go back and create the track record. In my mind, that should be a qualifying factor, but it's not. I think we've swung a little too far away from that, where common sense stuff, just like that as an example, kind of goes out the window. Yeah. But you have to have some guardrails in place, right? Yeah. So, they could say, okay, David, well, we'll bump the DTI to 55%. Well, then I'd have the same argument with you about, well, why can't we squeeze out 56 for this person in this scenario? So they had to draw the line somewhere, and I get it. It's just you're trying to take a one size fits all to everyone's unique position, and it's a tough thing to tell people when I get an application and say, hey, credit score is great, you got the down payment, but I can't do anything unless you dial back your search to 150,000, right?
Yeah.
And then they say, well, I've looked at 150,000. If I buy a house at 150,000, I have to be in an area where I don't want to be, or I have to buy a house that I don't have the money to fix up.
Right. Yeah, you're
So,
making me live in a
It's those people
fixer-upper.
that fall in that bucket that you kind of feel for.
Right.
That in 2000, going back to 2005, they breathe on a mirror they're in. So
Into
Yeah.
a house that's much more expensive than $150,000.
Yeah.
That's true.
Yeah.
Yeah, because
Yeah.
that's the problem with the policies back then was it was just
Well,
like,
sure.
Well,
Yeah.
Where
Yeah,
do I
yeah.
want to live?
yeah, you're exactly right.
Yeah.
But yeah, 2005, I remember, and we weren't licensed back then. You didn't have to be licensed. There was no regulations over us as loan officers. I remember I was at a brokerage. We were in Broad Ripple on right next to Connor's Pub. So our lunches were, martini lunches. And then some people would go out after work. There was one guy they hired that we caught sleeping in the office because he didn't have a home himself. So just to show you.
Did he know that he could get 100% financing?
Apparently this guy couldn't. And I don't know what the reason was.
Yeah.
But he was working for this brokerage and clearly was not I wouldn't want to get a mortgage from a person, not necessarily that doesn't have a home. That's fine. Like if you're renting, that's fine. I understand some people, it makes sense to rent versus buy. But if I'm talking to a loan officer and just trying to, have a personal conversation with them and I ask them where they live and he says, oh, I have a sleeping bag under my desk,
Yeah.
That's just, but that's what it was. It was kind of the Wild West.
Right.
And I don't think that guy lasted very long, obviously.
Yeah.
But you can't get away with that stuff these days. I mean, the way licensing is, you have to have your hours in, you have to pass the test. We have background checks now, which I'm sure this guy would have got hung up on. They do credit pulls.
You can't even see his tattoos right now. So.
I was hoping he was talking about the guy with the
No, I was
sleeping
talking about the guy at the brokerage, but yeah.
With the way you motioned,
Well, Stewart too. No, Stewart too. Yeah.
There's some tattoos under here for sure.
No, but it's
But
not an
he's
easy
bigger.
thing to get and stay licensed
Yeah.
for some folks, and
Yeah.
that was lacking until 2009, and then it went from being unregulated to super regulated.
Yeah.
And I don't necessarily think that's a bad idea or a bad move.
Yeah.
It got rid of a lot of people who shouldn't be doing it, and the main players who were exploiting those programs that, I can probably count on my hand how many, I guess we'll call them questionable loans that I did. I primarily did your FHA, VA, conventional, always have. That's always been kind of my sort of forte, I suppose. That's just what I've always focused on in the purchase world. But if you had a client back then coming to you and couldn't get qualified those normal ways, if I didn't talk to them about that program, someone else would get paid. They'd still get in the house. So, you kind of find a way to justify it in your head. But there are people who just did that and just focused on that stuff. And I don't know. I wish there was some sort of record of loan officer to foreclosure type of record where you could see
Who was doing it?
because you had your problem lenders, right? Like Lehman Brothers. There was a company called Aurora. There were companies that really focused on those things because they were making tons of money on them. But I would like to narrow it down to a database of the loan officers associated to the specific foreclosures and see, what kind of programs were you guys writing?
Yeah.
I mean,
Well, because when the
Yeah.
fallout with like Lehman Brothers and that happened, like yeah, maybe Lehman Brothers they were made the headlines, but all of their loan officers, like
they're working somewhere else.
They're still in mortgage.
Yeah, they're probably working somewhere else.
Yeah.
I actually know a lot of old guys that were in the mortgage world that did a lot of those types of loans when the industry changed, knew they couldn't hack it. And yeah, those guys are out selling like bootleg life insurance plans, like the bad ones, or they're selling used cars.
They just found the new
like,
financial, whatever the financial
just,
interest. They're crypto guys now.
It could be. Yeah. So it's just, it's funny. It weeded them out, put them in probably where they should be, kind of. But yeah, those were wild times. In 2008, 2009, those were some really lean years. But you know, you get through the storm, you adapt, you change, and you know, we're what, 15, 16 years past that now. So
yeah,
there's a way.
Yeah. I was gonna say I like being able to talk to, you know, someone like you who's been through 2008 in the mortgage industry, and just I do feel like depending on, you know, who you get in your feed, I feel like since 2019, I mean, I've been in this business since 2018, but I mean, even since 2019, 2020, when we started to head into this pretty intense seller's market and, you know, upward trend in price, people have been calling for the sky to fall, like, you know, for like the past 6 years.
Yeah.
So, you know, that sort of, and I get that principle in sort of in business to have that certain level of skepticism when you're looking at a market. You know, what goes up must come down, maybe, but also housing has been steadily appreciating since the 1940s. So
there is, and I didn't mean to cut you off.
No, but I guess that was where I'm leading, is like having kind of seen what the industry looked like pre-2008 and seeing what it looks like now. Do you see any parallels, or, you know, how do you feel?
From my perspective, I don't think we'll ever see a bubble like we saw in 2008, 2009. It's just, there's too many things in place now to prevent that from happening. You know, the fact that you as the buyer have to have a down payment, have to have skin in the game. I don't care if it's down payment assistance. You're still having some equity from somewhere, so you've got a little bit of wiggle room. And I don't think that the market will ever, we'll have periods of time where a home may slip from, let's say, 400 to 380, right? But we're not going to have some big swing of it going from 400 to 200.
Yeah.
Like, there's things in place now. The fact that lending is difficult, right? And you have to go through this rigorous process, and you have to have skin in the game. And it's just not, I don't see it happening. What happened was way too many people got financed for things they shouldn't have got financed for.
Yeah.
The bottom fell out. Those people didn't have much skin in the game. They walked away, right? That's what's created this huge foreclosure bubble. Huge foreclosures of your neighbors drag your values down, right? There's just
an overabundance of supply.
Exactly right. It's just, I just don't see a scenario in this industry where that happens again, barring some weird catastrophic event that is unrelated to the industry, right?
Yeah.
COVID-19, right? Like just surging things, something global pandemic.
Well, and that's a very interesting, like, that's a catastrophic event that sent our industry skyrocketing. Like
so it actually made borrowing money extremely cheap, right? And so people could borrow more, buy more of a house, and have a lower payment,
Yeah.
right?
Those are those 2 and 3% interest rate days that we will probably never see again.
Yeah.
Clinging on to mine.
Same. I'm never moving.
Yeah, exactly.
Yeah. So, I just don't see. Yeah, with COVID was interesting, and a lot of people thought the sky was falling, right? But I think in hindsight, looking back on it, it was kind of just a blip. Granted, COVID will be here forever now, right? And we all kind of get it every once in a while, and it's maybe not as big and scary as we all kind of thought it was, but it brought rates down, right? It allowed people to borrow money cheaply. And even if we have another similar event, I would imagine it's going to play out the same way. The only other thing would be if tons of people lost their job, right? A lot of people pivoted and worked from home during COVID, right? Still employed, still making money. If something should happen where people can't work, right? And there is no money, and it is a big global thing, and our economy tanks because of that, well then, that could cause issues with people making home payments.
Yeah, but at that point, maybe the housing market's probably the last thing you're worried about.
You're just trying to survive probably at that point.
Yeah. I think I agree with you. I think one of the most significant changes that came out of 2008 for me was it was that 70 to 80% AR of LTV requirement. So lender, depending on the loan program, like just the max that we can do, or the minimum down payment we can do, like we can't go to 100%. And even like the lowest you can get, like with an FHA loan, is 3.5. And I guess there's VA and USDA, but those are specifically like just really, and those are for a very relatively small percentage of the whole population, and for specific reasons that
veterans earned it, right? They can have it. They should have it, right?
Yep.
And then USDA 100%. If you want to live way out in the middle of nowhere,
at that point, you're helping us homes. You're helping us settle the country. You know? Like, so I kind of get the logic in those being 0% down payment, but I think for conventional loans in general, keeping that buffer zone, I do really believe that helps like protect, not just protect consumers, like protect everybody holding an interest, like the mortgage companies themselves.
Sure.
And just we're only allowing mortgage companies to make really conservative bets.
You're exactly right.
Yeah. So I think it's just interesting because it's and I feel like and I know Stuart and I are both millennials, so we're lucky for us. We're beating the odds, and we're both homeowners. But there's so many people in our generation, especially the next generation, that are like, never going to own a home. I feel like
they don't even see it on the horizon.
Yeah, it's like that's going to be impossible, and you kind of feel for those people, and there's almost a part of you that's just like, I don't want the market to crash because, like I said, I'm a homeowner, so I don't want to lose all my property value. But it's like I'd like it to almost. Maybe it can just like level off forever, for a very long time, and like let people catch up. But it's just hard when you think about what they're not making more land. That that phrase, the old adage, like and it's what a home is at the end of the day. It is an appreciating asset.
Exactly right.
We just have to depend on these like third and fourth generation farmers who have no interest in farming. To sell the when their parents pass away, they sell the land off, and then an Arbor Homes comes in.
The developers,
builds 3 neighborhoods on a plot, just to increase supply.
They come in.
Well, there is a lot of that happening.
Yeah.
I think Arbor's building a product for what, under 300, which is pretty amazing. Really, most new house stuff builders want to be in for 400 or 500 usually at a minimum. So
that was an interesting statistic. I was looking at. I was with a group of friends yesterday, and we were kind of talking about all of this, like this sort of the state of affordability and just the struggles of like millennial and Gen Z generations, and that it's a very interesting stat that the household, the median. Let me try to get this right. The median square footage per occupant in households. So home ownership has been declining. I think since 2004, it's gone from around 69%, and it reached its sort of low right before COVID, and then it kind of has recovered since. But it went down to around 60%, like overall, and then has bounced back to like 66. But overall, home ownership is on the decline. Yet square footage per occupant of U.S. households is increasing.
Is that right? Okay.
So it's something like 1,000 square feet per occupant, and back in the I don't know, back in the 70s, 80s, it was around 500-600 square feet per occupant. So we're building bigger houses. So people are making the argument, well, part of the reason why housing is more expensive is because we're just literally building more expensive houses.
Yeah, we're not getting them out of a Sears catalog anymore, right?
Yeah.
Post World War II, and they just ordered their house up from Sears and put it together for a couple $1,000. Yeah, those days are long gone.
Yeah. And I just think that's it blows my mind that like, why doesn't that exist in our market? Like, why is there no new small home product? And I think that it kind of does exist. I think I've seen examples from it's one of the production builders. I think they actually do operate here. I want to say it's Lennar, maybe.
Okay.
They do like a very small build in it's like one of the Texas markets, like San Antonio or Austin. That's just like this little 2-bedroom, 1-bath. Like it's like a loft, almost built kind of like a tiny home.
Okay. Is it attached dwellings, like townhomes?
They're not
almost,
attached. They're single families
you
that
own
sit
the
on
land,
these.
and
The parcel is probably maybe a tenth of an acre, probably smaller.
okay.
But it's
a place to start.
Yeah, I mean it's very interesting because like people see that and they're like, they think that's a problem now. Like look how small they're building these. But it's like actually that might be. I'm kind of looking at that. I'm
genius.
Like that might be part of the solution. Is like we need to build smaller like we used to build smaller houses.
Yeah, sure. Yeah, the builders. I mean, production builders. They're out to make money, right? Mm-hmm. And the more they can squeeze out on that little tract of land, I mean, it's to the point you go to some of these newer neighborhoods in like Westfield, and the houses are not massive, but they're, 3,000 square feet, give or take, and they are taking up almost every inch of the plot of land that they're sitting on, and you can reach out and high five your neighbor from the kitchen, that type of thing. I think builders are just trying to pinch everything they can out to turn a profit, and that's capitalism, right? But
well, that's I'll always say when people bring up that complaint of like, oh, they're the house. Why are we building these huge, 3,000 square foot the neighborhoods are all like 2,500 to 3,500 square foot houses? Like, I'll always it's like, well, this is a two-way thing. Like they're building them because people are buying them.
Exactly right. Yeah.
They're smart. They've done the math. They've tested different products, and they know that these are the ones that they can sell to the general public.
Mm-hmm. You're exactly right.
Yeah. And it doesn't, whether that's an investor or somebody who it's like their second, third, fourth home that they've maybe upgraded to it. The builders don't care like who's buying it. It's just which of these layouts gets us the longest line of buyers. So in a way, it's almost like this. If we're going to have that option of smaller homes, like it's not just on the builders. It needs to be almost this cultural shift that
Sure.
happens
Yeah, I get that.
all at once.
Yeah.
But that is one of my biggest pet peeves, what you mentioned with the builders, when they build like a 3,000 square foot house
man.
and you can reach out
Yeah.
and touch. It's
Yeah.
like, and again, it's like, well, they're building that because people will buy it. And I guess people just don't care about having a yard.
No.
They just want to technically live in a single family.
I know, which is wild to me. I'm on 3 acres,
Oh yeah.
so I've got some breathing room. Yeah,
That's a lot.
I can't imagine just being.
Our first
So
house
close.
was Arbor Homes, and it was,
Was it?
from the edge of our house to our lot line was 5 feet, and
Yeah.
so was our neighbor. So there was 10 feet in between every house.
Yeah.
Made mowing
I've
easy.
seen it 8. I've seen it down to 8.
We did not
before.
like
Yeah.
it. But like you said, people aren't voting with their spending dollars. If someone wants to live on 3 acres, they're not even considering Arbor or another one of these like Westfield builders. These are people who spend the majority of their time inside their house, and they don't want to have to cut a large lawn or whatever it may be.
Yeah.
But it's also it's a good way to start, right?
Yeah.
You start there,
Yeah.
right? It's inexpensive comparatively speaking.
Yeah.
Build up your equity, and then when you're ready, you swing your equity to the next one, put more money down, get a bigger house, right?
Yeah.
That's the formula.
Yeah, to be fair, if you're somebody who you're trying to get into if it's your first home, but like you've got 3 kids, and yeah, you've got 3 kids, so you have no extra time, and it's like, yeah, I don't want a big yard. Like
Sure.
I need this to be the layout that works for my family, but I can't, I need this to be built efficiently.
Mm-hmm.
So there's a reason that product exists.
Yep.
Sure.
Yeah.
Funny enough, we built with Arbor, I think 2017, 2018, something like that. And when we decided to sign the contracts, it was an empty field, right? There were no houses just yet. And it was exciting. And then once the neighborhood was finished and all the houses were 10 feet apart, and at the time we didn't have kids, but there was an army of children moving around in front of our house because of, all the neighbors
all the
had 2 or
neighboring
3 kids.
Sure.
And so we decided pretty quickly that wasn't what we wanted. And so I think we sold our house within about a year and a half and moved over to Franklin Township, and got really lucky that we made that decision right before the pandemic happened. And so we lucked into that 3% interest rate that we don't want to let go, and, better schools and everything. But so it's also all about timing too.
Oh yeah, 100%. That's the hard thing to get right, is the timing.
Yeah.
But when you do, it feels good.
Yeah. We certainly didn't make that decision because we knew that there was
had
an
the crystal
impending
ball.
pandemic.
No. Yeah.
Yeah.
It's like you had contacts in that lab. Yeah. Well, man, we got some questions here we've been wanting to run by you. I'm curious because you deal with the numbers of real estate so much. If you were working with somebody who, let's say, they want to get into investing in real estate, and they had $40,000 in cash that they're willing to put towards it, how would you advise them? Like, kind of, and you could speak to that more so than we can on the financial piece of it, or just if there's a type of asset,
Yeah. So $40,000, right, will get you 20% down on a $200,000 home.
Mm-hmm.
Any more on investment properties, you're looking at a minimum 20%. There are scenarios. In fact, Ryan, I think I had a client or 2 of yours that we talked about who don't have a primary residence currently, and we're looking at multiple families.
Mm-hmm.
You can get in and occupy one of those units as your primary. The mortgage you get will be a primary, yet you would have these other units you can rent out.
Yeah.
So that $40,000 would get you a lot further if you're willing and able to take on a property where you go in, occupy one unit, rent the others, right?
Yeah.
And you don't have to do it forever. You can rinse and repeat. You could go in, buy a duplex your first year, right?
Mm-hmm.
Move into one side, rent out the other, see how it goes, make sure you like it, right? Test the waters. And then from there, move on to another duplex or move on to a 3-family or 4. And you can do the same thing. You can move into that next one as a primary, again, minimum down.
Yeah.
Hang on to the other duplex, put that in your portfolio, and you can rinse and repeat.
Yeah.
I mean, there's nothing that's going to make you go back and amend those mortgages to an investment property, and you can do it. There's no real limit. I mean, for Fannie and Freddie, you can't own more than 10 finance properties. I know a guy.
So when you refi to like a portfolio loan or something.
At that point, you'd start looking at portfolio stuff. Yeah.
Yeah.
But I know a guy in Fishers I used to work with a lot. He did that. He was a young guy at the time. He would buy a home in, can't remember. Is it Sandstone? Is that one of the Fishers neighborhoods?
Yeah, I think so.
I could be wrong. Something like that. But he would go in, buy a house, live in it for 6 months to a year, rent it out, move into another house in the neighborhood, do the same thing to the point where he got, I don't know, maybe, I want to say he has maybe 6 or 7 that he did like that. So to buy an investment property, don't necessarily think of the straight, the only way to do it is 20% down. I have to qualify for investment property products, all that type of thing. That's not necessarily true. There are other ways to go about it if you're willing to live there as a primary first. The multifamily thing with FHA offers multifamily for primary. You can get in 3.5% down, right?
Yeah.
3.5% down, rent out the other side, create income, pay your whole mortgage, right? So you're living there for free. The renter's paying the mortgage essentially, and then go do it again. Or another thing you can do when you build up equity in a home, let's say you have a primary residence, right? And you have this other $40K sitting there. If you have equity in your primary, take out a line of credit against your equity. That equity is just sitting there. You can open a line of credit for nothing. Banks will open them up for you. You have to go through a little bit of an underwriting process, but it makes your equity available to you. You don't have to use it right away. You don't have to use all of it. But let's turn that $40,000 that you have, let's borrow $20K from a line of credit on your house, right? So now you're up to $60K. You can boost your purchasing power if you are looking to do a straight investment property.
Yeah, dude. I see a lot of people doing that. Yeah, after they've been in their primary for a while, I think we talked about Stuart's going to do that soon. No, but I think the term for the kids these days are using for what you're talking about is house. They call it house hacking.
Yeah.
With and so that is, so if somebody has that like $40K to start with, that'd probably be like your recommendation to them is like consider the house hacking method and go. And
if you already have a primary, if you already have a primary residence, right, and you don't intend to move, which a lot of people don't, right? They just want to pick up an investment property for the income, right? In that scenario, look at the house hacking. Borrow your down payment from a line of credit, right? Keep the $40,000 in the bank, right? If you don't need it, if you have enough equity, keep the 40 for the times the property's vacant, or you need to fix some things up or something like that. But you can buy investment properties without using your own money if you have equity to borrow.
Yeah, I've helped I think 3 or 4 people this year buy duplexes that they plan to occupy one unit, and they worked with a low down payment loan that allowed them to put very little money down. And then they're able to live in one unit, and the other unit essentially pays for their mortgage. Of course, sometimes you might have positive cash flow even in that scenario.
Sure.
If you're like willing to buy in a certain area. And sometimes it doesn't quite cover your mortgage, but you're still coming out ahead
But
when you're
your
considering.
portion is so insignificant.
Exactly.
Yeah.
And you compare that to like, okay, now I have to cover $200-$400 of my mortgage, and I was paying $1,400 a month in rent.
Mm-hmm.
And now somebody's paying most of my mortgage, and I'm building equity in this property. I mean, I think that's excellent advice. It's one of the best upgrades somebody can make.
Yeah, and take that $1,400 that you're paying in rent and keep paying it to yourself in a savings account, and then you'll have a down payment after a couple of years to put on
building
the next
from
one.
there.
Exactly right.
Let it start to snowball.
Exactly right.
Yeah.
I think part of the reason why, like Ryan said, that the kids are calling it house hacking nowadays is because when you're, let's say, in your mid-20s, I think like the perfect profile of someone that can do something like this is someone who doesn't have a lot of strings attached.
Oh, sure.
Yes.
Yeah.
So they can move once a year because they've been probably doing that since they were like right out of high school.
We meet a lot of tenants that are doing that with their apartment every year. You know, it's like, just do that with a house.
Yeah.
Yeah.
My guy in Fishers that was doing that eventually got married and slowed all that down.
Exactly.
But I mean, when you're young, 20s,
Yeah.
you know.
That is always like how I tease like the clients that I work with that do this. I always tease them because it's I mean, often it's like single dudes that are doing it.
Yeah.
And I'm always like, man, if I could go back, like I would be doing exactly you are doing exactly what I would do if my wife and child would allow it.
Yeah. I mean, this guy took it a step further. He would rent, so he would buy it as a primary, and while he was there as a primary, he'd have a couple buddies staying with him, paying him rent, right? And then he would say, hey, okay, you guys keep paying me rent. This is your place now to rent from me. I'm going down the street. I'm going to get some more friends to move in with me. I'm going to repeat this exercise. And it's worked really well for him until he got married.
Yeah.
Or one of his friendships soured with one of those tenants.
Yeah, I mean, I
friends.
guess you run that risk as well, right?
Yeah, I've got a buddy in Austin, Texas that I went to college with, and he's doing it like the single family style, like I call it the single family style of house hacking, which is I buy a 4-bedroom and get 3 friends, you know, and we're all just going to live in this house together. And I mean, you could be cash flow positive in that scenario, probably even more so. But then it becomes now you're not just a landlord with a lease agreement, like you're a roommate / landlord, which is that's a very different dynamic. And I think sometimes it works out great, and it's a great way to to get started. And sometimes that's where there's some drama involved in your first real estate investment.
If I did that, me and my friends in my 20s, if we tried that approach, I don't think the house would still be standing.
Yeah.
You know what I mean? So,
I was going to say, that seems like a really great way to create a party house.
Yeah, you have to be a little more disciplined, I think, than where I was back then. But
you have to keep your own security deposit.
Collect against yourself.
Yeah. Yep.
Well, what was I going to say? I hope that your friend in Fishers is hanging on to the house because he's not going to be able to sell them and buy other rental properties in Fishers.
Exactly
and Carmel
right. With that ordinance coming down.
Yeah.
That's start of 26, right? You have to register
before 2026.
You can
January.
You can pre-register. Now. Yeah. My understanding is if you own a property and you get registered, you'll be good to go. But that's what I'm kind of curious about, because I think...
Is it a one-time thing? Like, let's say, for instance, I lived in Fishers right now, had no intention of renting my place out, but...
You should register it.
Maybe in the future, I'm going to move, and maybe I'll hang on to it. I don't know.
Just go ahead.
Should I just go ahead and register it now? Is that what you do?
It's a rental I live in.
I mean, is that how
it's a great question.
I don't know if you can beat the system, but if there's a way to beat the system, is that the way to do it? Tell everyone in Fishers to register their home as a rental before January?
Yeah, I don't know exactly what their sort of verification process is. I know that I was reading into it that it'll like a lot of these kind of regulatory things, it'll be based on a like sort of a like file a complaint system. So I think it's one of those things like if you register your rental or if you're operating a rental and you're not registered, like as long as none of your neighbors report it, it's probably going to go, like you're not going to have a problem. But as soon as a neighbor reports it, then that's when I think the city can come in.
So it's not a scenario where, hey, I'm going to register my home. Okay, you can do that, but I'm going to rip your homestead off.
Yeah, that's a good question. I honestly don't know.
Not sure.
Yeah, that's one of those things where, you know, we should clip this and post it and get people to argue about it in the comments.
Yeah.
So everybody's got an opinion.
Engagement's good either way, right?
Sure.
Yeah, I was just curious how all that works. I know the deadline's January, but I don't know.
Yeah, it's coming up.
Is it as simple as filing and it's on the property forever?
Well, I know I've got an out-of-state investor right now from Seattle that is looking specifically to buy a property in Carmel before December 31st because they want to register it as a rental and be able to operate it as a rental, and because they know that the government's imposing this monopoly for them, so by just limiting supply to 10%. So
it's not happening in Carmel though, right? Is it only Fishers?
Carmel copied Fishers.
They did the same thing.
Yeah,
I didn't know that.
I want to say they both go into effect January 1st.
Okay. I knew Fishers did. I don't know. The chatter in Carmel, I haven't seen that light up, but
my HOA is copying Carmel and Fishers right now, trying to cap the number of
do
rentals.
The same thing.
Yeah.
Well, and a lot of HOAs were already doing that before.
10% rule, a lot of them have. Or
10% rule would be fine. They're trying to take the number of rentals that exist right now and cap it at that number.
Oh.
I think it's just like a general consensus of like we don't want more rentals.
Yeah.
Which I have mixed feelings about because, like you said,
well, you're in the business.
Well, there could come a time, 10 or
you move
15 years where we would want to keep our house, but I don't know. We'll see how it shakes out. We just had a vote this week, but I don't think we had quorum. So
yeah.
Well, and that just the way that policy sounds to me, like I made this same joke with like I think the people that lobbied the hardest for Carmel and Fishers to have this this policy, I think they probably all own rental properties.
Yeah, you're probably
like,
right.
Let's just have no more and let's own all the supply.
Yeah, and our rents go up.
Exactly.
Mm-hmm.
Like that's just going to jack the prices up, and I would, especially the way that policy is like, okay, just no more, just only us.
Yeah.
Yeah.
We're all
just
cool.
Me.
We're all the cool landlords.
So I guess the other thing, if Fishers, when these rent caps come down, how do you see that influencing people buying homes in Fishers, right? Do you think that a lot of people looking to rent are going to be pushed over to buy now? I'm talking owner occupants, obviously.
It's a really good question. I think that people that are looking to rent in Carmel and in Fishers, I don't think they're going to get pushed into home ownership. I mean, I think the optimist in me would like to see more of them become homeowners.
Sure.
But I think that for people that are, for one reason or another, determined to rent, they either for fear or for just they really just can't afford to get into home ownership. I think they're just going to get pushed to Noblesville and Westfield.
Okay.
I think they're just going to end up living in some of these probably other areas of Hamilton County, which are also nice, but they're not going to stay. So I actually do think you will probably see a decrease in demand. That'll keep the price of rent somewhat stabilized. I still think it's going to rise overall.
I would think it has to, right?
Yeah, because you're just cutting off supply.
Yeah.
But I do think that there will be like a small decrease in demand because you're going to push a certain amount of tenants like that will just they're just going to be like, no, I'm not going to.
Hey, we want to be in Hamilton County. They're not doing this in Westfield or Noblesville.
Yeah. Or they're just going to keep going to markets where, and they might not cite the reason as like, oh, it's because they did this rent cap, but they're just going to feel the squeeze of like you're just going to see a lot of people being like, oh, rent's too high in Fishers and Carmel, and these suburbs are going to develop this reputation as being like they're just going to be too expensive.
Yeah.
Like rent wise. So I think you're going to see a lot of that population like leave.
Okay.
Which is, I don't know.
Well, I completely agree. And to David's point from earlier, I think it's going to pinch people because they might not be able to leverage these mortgage programs that you mentioned because they can afford $2,000 a month in rent, but like their debt to income ratio isn't going to work out for them to be able to buy like an adjacent property in a neighborhood nearby where they live now.
Or paying $2,000 a month in rent for so long they don't have any savings necessarily to speak of, right?
Yep.
So,
yep. There's going to be a lot more commuting too, because like maybe those residents have kids in schools there and they don't want to move their school, so they're going to be they're going to be driving from Westfield over to drop their kid off at school or go to work or whatever it may be.
That's true. You might see people moving. You might see people going the other way too, going to north side of Indianapolis, just to to find a place to rent.
Sure.
Just places that don't have that.
Yep. Well, cool.
Yeah. Wow. We have
we got the whole time block.
So much to talk about. I guess before we wrap up here, where can people find you? Do you have anything you want to plug? Website, social
so you can
media?
always check us out on our website. It's powellhomemtg.com. We also just rolled out a mobile app called Loan Simple. You can do pre-approval application on the app. We rolled it out for both realtors and for buyers. So realtors can go in there, see who they have pre-approved through us, check their approval amounts, etc. It's got API where you can, a buyer can go in and type in an address. On the back end, we've already input their limits and interest rates and things like that. They just type in an address and it'll spit out an estimated payment.
Yeah.
So I know a lot of times on nights and weekends, especially if I'm trying to get my daughter down or if I'm out on the boat or something like that, you can't get a hold of me, need a payment estimate before someone puts an offer in, they can just hop on the app, plug the address in. It should include taxes, insurance, all that right there at their fingertips. So it's called Loan Simple. It's out on the Apple App Store and it's in Google Play now.
Nice.
Still kind of in the pilot stages. We haven't done a big official release or anything, but it's out there and operable.
Yeah, that's huge. That's very cool because this is your Loan Simple is unique to.
This is us. We engaged a developer and it took him. I mean, there's a lot that goes into it. It's taken him 7 months or so to put all the coding and everything in and. We've been working on it, and finally got it pushed out to the stores, got the approval and all that. So it's out there. I'm not saying that you might not find a glitch or a bug, but you can screenshot them, send them to us, we'll get them fixed. But
yeah, that's what updates are for.
Yeah. should be working pretty well.
Yeah, very cool. Yeah, I'm excited to look at that and check it out.
Yeah.
Well, yeah. Thank you for coming on the podcast, David. I feel like you were able to share such great insight from your perspective in the mortgage industry, and I know I really enjoyed this conversation. So appreciate your time.
Likewise. Appreciate you guys having me on. Appreciate what you guys do, and keep it up.
If you enjoyed the episode, please leave us a 5-star review on Spotify and like the episode and subscribe to our channel on YouTube. That really helps us out.
If you think someone that you know could benefit from hearing the things that we talked about on today's episode, please share it with them.
You can check out our full library of episodes wherever you get your podcasts. And if you have any suggestions for the show, like who we should interview or a topic we should discuss, please email us at circleinvestorpod@gmail.com.
That's it for today, but join us right back here next week for another episode of the Circle Investor Podcast.